Good day. Thank you all for joining us. I'm Joe Kennedy, Senior Fellow at ITIF, and we're here today to talk about digital services taxes. We've got an excellent panel today. The run of show will be I'll talk for about 15 minutes about a paper I recently wrote with ITIF. And then each of the panelists would talk for about 10 or 15 minutes about the general subject. And then we might have a back and forth among the panel, and I'm going to try and leave lots of time for audience questions. So the first thing I'd like to do is introduce the panelists, starting from me and going down. Daniel Bunn is currently Director of Global Projects at the Tax Foundation, where he researches international tax issues with a focus on tax policy in Europe. Prior to joining the Tax Foundation, Daniel worked in the United States Senate at the Joint Economic Committee as part of Senator Mike Lee's Social Capital Project. He also worked on the policy staff for both Senator Lee and Senator Tim Scott. In his time in the Senate, Daniel developed legislative proposals on tax, trade, regulatory, and budget policy. He has a master's degree in economic policy from Central European University in Budapest, Hungary, and a bachelor's degree in business administration from North Greenville University in South Carolina. Freddy Wooten is Second Secretary Economic in the British Embassy. He's been in D.C. for 18 months, working in the economics team. He covers the U.S. economy and fiscal policy. Freddy's on loan from Her Majesty's Treasury, where he most recently worked with the G20 and the G7. He studied politics at the University of Exeter. Barbara Angus is a leader of global tax policy with Ernst & Young. In this role, her focus is engaging with clients and governments on tax policy development and implementation across the globe. Barbara previously was Chief Tax Counsel for the Committee on Ways and Means of the United States House of Representatives. She was appointed by then Chairman Brady in February 2016 and served in that role until the close of the 115th Congress in January of this year. She had responsibility for work on all tax matters before the committee and played a key role in the development and enactment of the Tax Cuts and Jobs Act of 2017. Barbara received a Distinguished Service Award from the Tax Foundation last year. She was included in a list of 10 outstanding women in tax published by tax analysts in 2016. She received an A.B. in Mathematics and Economics, magna cum laude from Dartmouth, a J.D. cum laude from Harvard, and an MBA in Finance and Accounting with high honors from the University of Chicago, Graduate School of Business. So I'm really looking forward to what they have to say, but I get to go first. So just to repeat myself, hopefully for the only time today, I'm Joe Kennedy, a senior fellow at ITIF, and I authored a recent report on digital service taxes, a bad idea whose time should never come. You can, if you're joining us over the web, you can download it at itif.org, or you can, for those of you who are here in person, there are copies in the back. And I should mention that we encourage you to join the conversation under the hashtag of ITIF digital taxes, ITIF digital taxes. So why is this topic important? For one thing, several countries are currently moving forward to enact a version of it. These taxes would substantially change the existing rules for taxing multinational companies, especially the largest internet companies at whom these taxes are squarely aimed. Besides complicating the international tax rules, these unilateral efforts would make it harder to find agreement on the legitimate issues that plague the current system. And I should mention, just yesterday, the OECD issued a report in which its members pledged to make a concerted effort over the next year and a half to deal with some of these underlying issues. Today, Today, I'll cover 4 topics. First, how does the existing international system for taxing the profits of multinational corporations work? Second, what's a digital services tax? Third, why do the proponents of DSTs believe that they are justified? And finally, are these justifications valid? The current international system is the subject of a number of multilateral treaties. It is also fortified by literally thousands of bilateral treaties that mesh the respective corporate tax codes of 2 countries in order to specify exactly how a company that operates in both countries will be treated. The system is built off of 5 main principles. The first is that all corporate profits should be subject to tax somewhere, but they should not be taxed in more than one country. Second, the distribution of corporate profits among countries should reflect the amount of value created in each jurisdiction. So if 10% of the price of a car is produced in France, then France should get to tax roughly 10% of the profits from producing that car. Third, the mere sale of a product does not create value. The product is considered finished when offered for sale. Fourth, companies must have some sort of permanent establishment within a country before they can be subject to that country's corporate income tax. A company that merely imports a product or service with no other involvement inside of a company is not subject to that company's corporate tax. It could be subject to sales tax, however. Finally, the value placed on the transfer of products and services within a company should reflect what 2 independent companies operating at arm's length would agree to. Trends in international trade have placed strain on this system, however. The rapid decline in communication and transportation costs has made it easier to move production to low-cost jurisdictions and to export to the rest of the world. Liberalized trade agreements have made importation cheaper, and the rapid growth of services and intangibles as a source of value has made it even easier to move these across borders. Finally, increased digitalization has made it more difficult to track where value is created and has reduced the need for permanent establishments. The result has been increased tax competition. Over the last 2 decades, a number of major countries have substantially lowered their corporate income tax rates and implemented tax policies such as an innovation box or an R&D tax credit to attract companies to their jurisdictions. Yet many nations continue to fear that tax competition will erode their tax base, resulting in lower revenues and greater budget constraints. The international community has dealt with some of these problems. The OECD's base erosion and profit shifting plan involved roughly 140 countries. Over the last 6 years, it has resulted in 15 broad action items that are now being implemented. Important reforms have included a toughened requirement that internal transfer agreements reflect economic reality, as well as enhanced information sharing among national tax agencies. These efforts looked at broader challenges as well, and over the next year and a half, nations will try to develop solutions to many of the general concerns about digitalization. So what is a digital tax? Services tax. Digital services taxes are best seen as part of a broader effort to direct more corporate tax revenue to destination countries where users live. Since users are less likely to relocate due to tax considerations, tax revenues based on them are viewed as being more secure. Some of these efforts are legitimate attempts to ensure that foreign suppliers end up paying the same amount of taxes that domestic firms are already subject to. However, the main argument for a DST has been that for a limited range of businesses, much of the value in the service is created by users, not the company offering the service. As such, the profits from that value should be taxed where the users reside, not where the company operates. For most of 2018, the European Commission advocated for a proposal that would have required each of the European Union's members to adopt a DST. The proposal required unanimous consent from all countries to pass. By the end of the year, it became clear that opposition from Ireland and Nordic countries would defeat it. Although the proposal is dead at the EU level, a number of countries, both in Europe and outside of it, are moving forward to enact their own versions. Although the details vary from country to country, most proposals have the following components. First, they're a tax on revenues, not profits. Proponents argue that because of this, they are not governed by the many bilateral tax treaties. Second, the tax rate is low, usually 2 or 3% of revenues. However, this calculation is deceiving. A 3% revenue tax on a company with a 15% profit margin actually amounts to an income tax of 23%. In some proposals, companies would have to pay this tax even if they're losing money. Third, the proposals only apply to large companies. The EC proposal would have applied only to companies with annual worldwide revenues of over 750 million euro. And then taxes would have only been assessed on EU revenues that were above 50 million euro. Finally, DSTs are targeted at both a narrow group of business models and a narrow group of revenue sources. Although there's some ambiguity in some of the statutes, countries say that they only intend to target firms that are offering social media platforms, internet search engines, or online marketplaces. Even within these companies, revenues would only be taxed if they come from the sale of targeted advertising, the sale of user data, or commissions from online market platforms. So what are the arguments put forward for a digital services tax? Many critics of the large international companies claim that they pay significantly fewer taxes overall than other industries. But the main justification for a DST has been that in these industries, users create much of the product's value. Proponents mention three main sources of user-created value. The first is user-generated content on sites like Facebook and YouTube. This content attracts millions of users, allowing companies to sell advertising that users must watch. Second, users often have to provide information about themselves. Platforms can then use this data to target ads at them or sell the data to other companies. Finally, users patronize sales platforms such as Uber and Amazon. Every time a buyer or seller uses the platform, she makes it more valuable to other participants. Without these sources of user value, DST proponents allege that internet firms would be far less profitable. So we'll look at some of the justifications now. As a first matter, the claim that internet companies are undertaxed is false. The allegation is based largely on one study, but both the study's author and the EC's own watchdog have criticized the conclusions drawn from it. At least two other studies show that the total tax rate paid by internet companies is comparable to, and in some cases above, that paid by other industries. DST proponents also exaggerate the degree to which highly digitalized companies differ from other firms. The broad forces of globalization and digitalization are affecting an increasing number of industries. The Internet of Things and a continued emphasis on services will only increase this. In a recent report, the OECD warned against trying to ring-fence the digital economy, precisely because the borders between it and the rest of the economy are both porous and shifting. But even on their central arguments, DST supporters mischaracterize routine transactions as user-created value. On the subject of user-created content, most users post very little, yet they get free access to the social platform. The vast majority of what is posted has little value except to the person who posts it and a narrow group of people in their network. Of course, a very small portion of users post material that is widely shared. However, these users are already compensated for their efforts in the form of fame, influence, and in many cases money. To the extent that users are creating value, they do so for their own purposes, not to benefit the social engine. Nations typically do not tax donations of free labor, even if they benefit the recipient. We should ask why so many people post so much material. It's because the platform offers them an easy way to do it and surrounds that service with a variety of valuable functions. This is the real source of value behind the service. Users are likely to go on posting material until another company offers a better service, and then they'll move on. Companies do benefit from the data they collect from users, but this is increasingly true of all businesses. The Internet of Things will make it easier and cheaper for companies to collect data on the products that they sell to customers. Yet the internal use of customer data would not be subject to the DST. These transactions are best viewed as the sale of a service, which typically is not viewed as adding value. But in this case, the user is providing data instead of money in exchange for access to the service. The popularity of this business model among users indicates that it might be a better model overall. And the data collected often has little use outside of the specific context in which it's gathered. Finally, once again, the central source of value is the algorithms and business model that attract so many users. Finally, people use market platforms because they offer the best selection of goods and services. If Uber and Amazon were not easier, cheaper, and better to use than their competition, customers would quickly leave it. Although network effects do exist, users are drawn to the platform itself, not to the individuals on either side of it. Moreover, it makes no sense to tax multinational or multi-vendor sites, but not to tax single-store sites as the DST would. Doing so gives companies like Amazon an incentive to squeeze small producers out so that they can avoid the tax. Finally, there are a number of other reasons to reject DSTs. Despite the focus on revenues, they may still violate tax treaties with other nations. More likely, as ad valorem taxes faced largely by foreign firms, they are a form of tariffs and likely violate trade agreements. The fact that they are explicitly aimed at a narrow group of large, almost totally foreign companies gives them the appearance of a revenue grab, and their unilateral nature will only make it more difficult to deal with the real problems facing international tax systems over the coming year and more. Finally, it seems clear that countries could accomplish the same effect, more or less, by instituting a value-added tax within their territory. But to pass muster, this value-added tax would have to avoid discriminating against large and foreign companies. Unfortunately, this would significantly weaken its political appeal. So thank you very much, and I'll turn it over to Daniel. There's that button.
Thanks, Joe, and thanks everybody for coming out this morning. I'm going to talk a little bit about digital services taxes in Europe. One of the things that Joe mentioned is kind of an overall design for these taxes, but despite there being an overall design and an overarching EU proposal last year, the way that countries have gone about designing their own particular digital services taxes varies a great deal, even within Europe. So Joe mentioned that there's an applicable rate, that it normally applies to revenues, and then that there are thresholds that apply to these the companies that would be subject to the tax. So normally there's a worldwide threshold. So once you're a company with revenues over, say, 750 million euros, and local revenues over a certain threshold, and this varies, then you would be subject to the tax. And that's where you get this discriminatory effect to large foreign multinationals. So this is a map of European countries that have either already adopted some sort of digital services tax or considering them. The range of progression on these proposals goes across the board. So we'll go counterclockwise here, starting with the UK. So Freddy's going to talk a little bit more in depth about the UK proposal, but it's a 2% tax on digital services for in-scope revenue. There's a global threshold for revenues at £500 million, and then a local threshold for revenues at £25 million. So once you're in that situation, you're being taxed in that manner. And one way to think about this, and Joe mentioned this a little bit as well, is that if you have global revenues, let's just keep it real simple. Let's say you have $100 in, or £100 for the UK, in revenues that are in scope. So if the digital services tax applies to all those revenues, then you would owe £2 in tax connected to the digital services tax. The UK's corporate tax corporate tax rate is 18%, 19% right now, with potential for it to go down in the near future. We'll see. But if the profit margin on the £100 of revenues is 10%, then you would pay a similar level of corporate tax as you would digital services tax, basically attributing to that £100 of revenue somewhere near a 10% profit margin for the UK jurisdiction. So thinking about this, the way that different countries apply this rate is basically countries applying or attributing to these revenues different levels of profit margin, regardless of whether they're actually profits. As Joe mentioned, in some cases, companies could be running losses and still face the tax. So as we go through, I may mention that scenario or a similar scenario again as we go through these different countries. Belgium is looking at a 3% digital services tax, kind of designed off the EU proposal with a 750 million worldwide threshold and 5.5 million EU Belgium threshold. France 3%. Similar thresholds, and the French proposal is actually, of those being considered, probably the furthest along, and it's possible we'll have final details on that later this summer, potentially relatively soon, depending on whether they decide to actually go forward with it. Spain is in a bit of a interesting situation. They have a 3% proposal that would apply to a relatively low Spanish revenue threshold of 3 million euros. And they have a bit of a budget impasse and a political situation that may delay the implementation of their proposal. Italy is on its second digital services tax proposal, and the implementing regulations were supposed to come out at the end of April. They did not. It's possible that this would come back to life in some other form. They also have an interesting budget situation that may call for new revenues, but it's not necessarily, as Joe was pointing out, optimal for them to choose a discriminatory tax to patch budget holes. Austria has a digital advertising tax proposal that would apply at a 5% rate specifically to digital advertising. Some of the political message around this has been that they have an existing advertising tax that applies to traditional media at a 5% rate, and they're simply extending it to digital advertising, except the tax base for the traditional media advertising tax is different than the digital advertising tax, and it's a question of whether you're actually extending an existing regime or really just creating a new tax. Hungary has had a digital advertising tax for some time and had a dispute with the EU based on its thresholds. It had a progressive digital advertising tax, multiple rates, and the EU basically said, no, you can't discriminate based on you basically can't have a progressive digital advertising tax. They have a 7.5% rate for their digital advertising tax, which is pretty significant. And not too far away, Czech Republic is considering a 7% digital services tax. So back to that original scenario I was talking about with the UK potentially having relatively similar revenues depending on whether they're attributing a full 10% profit margin to the business. You would have to, if you were in Czech Republic, you would have to attribute a much higher level of profitability to be able to say you're taxing digital services in a similar way that you were taxing corporate income, because the 7% rate is so high. Poland is also considering a digital services tax. There's a lot of open questions on that front, but they're in the mix as well. And one of the interesting things about these proposals generally is there's an argument that countries make about the need for more revenues from digital companies. But the scale of the revenue estimates that countries have come up with, mostly based on math that the European Commission used in its impact assessment, the scale is relatively small. So the European Commission, we'll start at the bottom line here. The EU digital services tax proposal, there was a full European Commission impact assessment that had multiple estimates for the way these taxes could be structured, what they could apply to. But for the 3% digital tax on advertising and marketplaces and intermediaries, they were expecting to bring in 1.1% of corporate tax revenue with that mechanism. Well, countries, when they're looking at implementing their own solutions, they're looking at the different thresholds they could use, the different rates, the different bases, and they're ending up with some obviously different numbers. But it's interesting, before I go into the individual examples, just to think about how relatively small these taxes would be compared to overall corporate tax revenue in some of these countries. So Austria, with its narrow focus on digital advertising, is only expected to bring in 0.3% of its 2017 corporate tax revenue with this digital advertising tax. It could ramp up as more companies are brought into scope or as it's implemented, but that's an expectation there. France skews a little bit closer to the EU baseline, simply because their proposal is, and this is the revenue score from the proposed legislation, not an update that as the French proposal has gone through the legislative process, but it's designed based on the EU proposal. Italy also has a lot of features similar to the EU proposal, but expected to bring 1.6% of corporate tax revenue, and Spain has a much higher level of expected revenue, and the European Commission has actually said that they don't necessarily agree with the revenue generating capacity that they estimate from their digital services tax. I would mention, though, that the Spanish proposal is different in that it has a much lower threshold for Spanish revenues for the digital services tax to apply is just 3 million euros. And then the UK, again, this is similar to the Austrian situation, where you might have a ramp up over the course of time for it to become a more significant contributor to the tax revenue base, but initially a 0.5% tax revenue increase from the digital tax. And one of the challenges with these numbers is estimators are basically having to assume what they're bringing into their tax base. One of the concerns that folks who are proponents of these policies is that there are revenues that are out there in the world that should be part of their tax base that currently those revenues are not part of their tax base. And in order to estimate how much revenue you're bringing in, you have to make a lot of assumptions. There's all sorts of assumptions in any revenue estimation, but figuring out what's outside of your tax base when there are companies that are currently not potentially reporting any revenue or any numbers that you could use to evaluate what tax they might pay, and then saying, okay, we're bringing this in, we're going to have to figure out what the score is. And this is a similar challenge. Barbara's going to talk a little bit about what's going on at the OECD, but a similar challenge that countries all around the world are going to have figuring out what revenue impact different proposals will have when they're talking about changing which countries have taxing rights over which portions of revenues. So I'll turn it over to Freddy now. And he can talk a little bit more about the UK proposal.
Thanks very much, Daniel, and thanks, Joe, for getting us together. I'm grateful to have the opportunity to speak a little bit about how the UK is thinking about this debate, and I'll also talk a bit about specifically how our version of the digital services tax will operate when it comes into effect. I think the first thing to say is that clearly digitalisation has been a hugely positive force and has brought great benefits to the UK economy and the global economy, but it's also important to recognise the fact that it's brought about such profound economic changes, and that those changes do inevitably pose challenges to some existing policy. And I think corporate tax is an obvious example of where such significant changes to the way businesses are generating value and acting around the world will inevitably lead to some tension with existing corporate tax principles. That said, the UK remains very much in support of the sort of core principle of the way international corporate tax works, which is the basis of taxing profits dependent on where the businesses in question are generating those values, but the application of that principle has been strained by the process of digitalisation over recent decades. So an example, and I take Joe's point about, as a user of social media, questioning the value of some of the sort of cat videos and selfies in front of the Eiffel Tower, but it's still clear that some of these social media platforms, for instance, rely exclusively, extensively, and in some cases entirely exclusively on the content generated and produced by users, and then the interaction of users on that site, and that can take place in the same jurisdiction where that company might be headquartered, but it can also effectively take place worldwide, and you could have a significant and highly engaged user base from a business that's based in the UK in a country where that business has very little physical or legal presence, and vice versa, a company from elsewhere in the world with a large and highly engaged user base in the UK but limited physical or legal presence there. And these sorts of phenomena are new and important changes to the way the global economy is working, but they're not reflected in the current corporate tax rules, which is leading to unfair and unsustainable outcomes. So the UK's preference has always been to address these challenges at the OECD, and the UK has been playing a central role in discussions there since the very start. So I think, as Joe mentioned, the BEPS process, which began, I think, back in 2013, sort of launched the discussions as one pillar of that was focused on the impact of digitalisation on corporate taxes. Those discussions continued for a number of years and then ended in 2015, ultimately with no agreement in place. I think the discussions then restarted, and there was some progress and lots of interesting meetings at the technical level, but no significant progress towards agreeing and implementing an international solution, at least until, and we very much welcome the progress that's been seen And I think Barbara may speak a little bit about the OECD through 2019 and since the turn of the year. But there's still some way away before a sort of international solution is actually agreed and in place. Turning now to the UK position in a little bit more detail and the DST specifically, it's very clear that some businesses are increasingly and uniquely deriving value from the business's interaction with a user base. It's important to say as well that the UK doesn't see this as a problem as one of tax avoidance, but rather it's about ensuring that the tax rules properly acknowledge where and how digital businesses create value. So another example might be a search engine which is provided free effectively globally, and it's the sort of free provision is essentially in exchange for user data regardless of where those users are. And again, there could be a sort of highly engaged user base in countries spread throughout the world. And in these examples that I've given, the user interaction with the platforms is an important source of value generation which needs to be reflected in the corporate tax framework and corporate tax rules. So the digital services tax is intended as an interim solution to those challenges that I've discussed pending agreement to international rules on taxing profits. So the DST reflects concern amongst the UK government that the pace of OECD progress is moving too slowly, and question marks about whether a definitive OECD solution will be agreed and in place next year. So Daniel spoke about it briefly, but for the UK's DST is a 2% tax on the gross revenues of companies, on the UK-based revenues of companies operating three specific business models, which the government has identified as being the business models with the sort of hallmarks of a stream of revenue which is generating most value through the interaction between the business and the user. So that's a search engine, a social media platform, a social network, and an online marketplace. So it would be the 2% tax on the revenue associated with those specific business models, which might form the entirety of a business's revenues, or it might just form a portion of a business's revenues, but it's just those revenue streams that are highly integrated with user-generated value, or sort of the interaction between the user and the business generating the value. I think another feature, because one of the criticisms levelled is that it can lead to a sort of high effective corporate tax rate if you were making a comparison between the revenue tax and a corporate tax. In the UK's case, partly in recognition of the challenges associated with revenue taxation, the proposal includes, and the DST will include, a safe harbour provision, which is essentially protection. So under the definition of a safe harbour, if a company has a low profit margin, it will pay a lower rate of DST, and if it's loss-making under the definition of the safe harbour, it wouldn't pay the DST, which is, as you know, designed in protection for sort of small and growing companies, or companies that are making low profit margins. And I think that the low rate and the inclusion of the safe harbour is some evidence of the fact that the UK DST is designed to be proportionate rather than as a means of maximising revenue, which I think is partly evidence in the chart Daniel put up of the sort of proportion of revenue brought in. It's also important to just restate that the UK DST applies to businesses regardless of where they're headquartered, if they fall in scope based on the revenue thresholds and also the business activities that I mentioned, and generation of a significant value from those business activities in the UK. So regardless of whether it's a UK-based firm whose user base is entirely in the UK, or whether it's a firm from elsewhere with a significant user base in the UK, the tax is agnostic about the location of the headquarters, and it's also agnostic about the means of revenue. So whether the revenue is brought in by online advertising sales or sale of the data, as Daniel and Joe mentioned, or whether it's from it might be a subscription service. Some social networks might monetize their sort of interaction between the user base through online advertising sales, or they might have no advertising and it might be a subscription-based service. The point of the DST is it's this principle of user interaction with the platform and user interaction between users on the platform, which is playing a significant role in generating the value, not the way in which that is monetized. I think another feature just to draw out of the UK's thinking and policy making on this process is that it's sort of been developed over a number of years and hopefully well signalled to the business community and the tax community, and also in consultation with the business community and tax community in the UK and worldwide. So there was a position paper put out back in late 2017 which set out the UK government's thinking and proposals for global reform, and that also included some material which suggested that if there is insignificant progress and there's no sign of agreement at the OECD in implementation of global reform, it might be necessary in time for countries to move forward unilaterally. Moving through 2018, there was sort of update to that position paper, and I know that the government and the Treasury received a lot of very helpful input from companies around the world and from the UK and from tax experts, which have helped to shape UK thinking. If we then got to the sort of back end of 2018, and at that stage there was still sort of limited progress and there wasn't sign of a sort of imminent agreement and implementation of an agreement at the OECD. So the Chancellor at the budget in late 2018 announced that the UK would go ahead with a digital services tax, but that tax won't come into effect until April of 2020. So while I'm sure businesses would also always be grateful of more time to prepare for the implementation of a new tax, I think the UK has tried to give as much time as possible, firstly for very detailed consultation, because as I've said, these are sort of complicated new phenomena in the global economy, so much of the first portion of this year has been spent engaging with businesses who think they will be affected by the DST to make sure the design is carefully, the tax is carefully designed so that it operates as intended and is as administrable for the companies. So it's been important to give time to carry out those detailed consultations, and then that sort of brings us up to the present day. So that consultation has now formally ended, although the government's still very much open to input and views from businesses and other tax experts. So if that's something you're interested in engaging with, then I'll sort of encourage you to get in touch. But we're now in the process of developing the legislation, which will be published over the summer, I think. And again, that will give businesses several months where they'll have the detailed, at least draft legislation, which will then eventually go through Parliament late this year. And again, the tax won't come into effect until April 2020. And again, that's on the basis that there is no agreement in time at the OECD. The Chancellor's been very clear that the DST is always meant to be a temporary and interim solution which would be replaced when a global solution is in place. So, and the UK is very much working towards that. So just turning finally to some comments on that OECD process. Like I said, the UK has been very closely engaged with it from the start, and an international solution has always been the UK's preferred outcome. That said, it's important that a solution internationally does respond to the challenges that I mentioned at the beginning that are posed by digitalisation. So there's a legitimate debate ongoing within the OECD that the UK is very much engaged with about which businesses and which sectors have been impacted most by the process of digitalisation. But it's also true that that process has not affected all businesses to the same extent. So it seems clear that a social media platform has been more heavily influenced by digitalisation than a watchmaker or a beer producer might have. So my colleagues in the Treasury are working hard with the OECD on sort of rapid and the urgent work to find an agreement and to discuss which business models are posing the greatest challenges to the existing tax system, and we welcome the fact that in the last few weeks there's been a work plan agreed at the OECD and subsequently endorsed by the G20 to continue ongoing work in this area. But I think challenges remain, and the outcome of those discussions are uncertain. So the preparation for moving ahead with the DST will continue, like I said, until an appropriate international solution is in place to replace that temporary tax. But the UK is working very closely also, for what it's worth, bilaterally with the US Treasury and with colleagues and with the OECD staff to find an agreement and a compromise on this issue. Thanks very much.
Thank you. It's a pleasure to be here this morning. And as the prior speakers said, I'm going to talk a little bit about the OECD project, which is directly related to the activity that's happening around the world with respect to digital taxes. I think it's fair to say that governments and multilateral organizations have begun to express concerns about the implications of uncoordinated unilateral activity with respect to digital taxes. And that has led to a new OECD project focused on addressing the tax challenges of digitalization of the economy. I think the OECD project, could be described as either described as a new project or as a continuation of the BEPS project that began in 2013. That project did have a focus on the digital economy in action item 1, and the outcomes with respect to action item 1 in that project were less significant than the outcomes under the other aspects of that project. So in some ways, it's a continuation of that work. But I think in other ways, this new project is both broader than the BEPS project and more fundamental, because they're really looking at the new project is looking at the overall framework of the international tax architecture. The new project, the G20, as it did with the BEPS project, is very involved in the new project, and as the OECD and the BEPS project developed, did outreach to other jurisdictions and created what is known as the inclusive framework on BEPS. That larger group is actively participating in all of the work on the new project, and there currently are 129 jurisdictions participating. So it is truly a global project. It is a project that the OECD is undertaking under an ambitious timeline, and that timeline is driven by the activity that's happening around the world with respect to digital taxes, needing to keep pace with that because of the interaction between the two. The U.S. Treasury is very actively engaged with the OECD on this digital project. And it seems to be from all of the commentary from the U.S. Treasury participants, driven by the perspective that the activity around digital taxes and the aims that underlie that activity in countries around the world creates a risk to the overall framework for international tax. And that potential disruption of that overall framework needs to be prevented through coordinated work to adjust the international tax architecture to take into account the modern digital economy, and so the U.S. Treasury is very focused and actively participating in all aspects of this OECD project. The OECD project has also gotten attention from the Hill. There has been from the beginning the first activity in the European Union, and then the activity in UK and France and elsewhere has drawn reaction from tax writers on the Hill, concern about the targeted nature of digital taxes, and concern about the uncoordinated nature. And most recently, we saw a joint statement by the chairman and ranking members of the two tax writing committees, expressing concern about unilateral action, and specifically the digital services taxes that have been proposed, and their adverse effect on U.S. businesses and potential targeting of U.S. businesses, and in doing that, the policymakers on the Hill cited the OECD project as the OECD framework with the 129 jurisdictions as the appropriate place to have discussions in order to develop a coordinated approach for addressing the issues related to the tax effects of digitalization of the economy. The statement goes on to say that that the lawmakers are engaging regularly with Treasury as Treasury participates in these global discussions, and that they are looking forward to evaluating the outcomes of the OECD work. So they have not endorsed what the OECD will come up with, and in fact we saw when the OECD had a public consultation on this project in March, the two tax writing committees asked for an invitation to be given to staff of the Joint Committee. A couple of the international tax experts on the Joint Committee staff attended the consultation, and I think that reflected the clear interest in what's going on from the two tax writing committees. So, as was mentioned, the OECD on the 31st of May put out its work plan for addressing the tax challenges of digitalization. It is an ambitious project with a really aggressive timeline. Again, the timeline driven by the fact that there is activity happening in countries around the world, and really I think it's fair to say that the objective of the project, as reflected in the work plan, is global agreement on a new international framework for taxing multinational business activity. What is at stake in this work is the allocation of taxing rights among countries, and that's really more fundamental than what was at stake in the action items in the BEPS project. When we're talking about modifying the allocation of taxing rights between countries, by definition, you're saying that if one country, as a result of the new framework, gains additional taxing rights, there must be a country or countries that have had their taxing rights reduced. If that doesn't happen, then you've got double taxation. And so I think it's fair to say that there are winners and losers in this project, either countries losing taxing jurisdiction because someone gained additional taxing jurisdiction, or multinational businesses losing by being subject to double taxation, and the entire international investment and trade framework suffering from that double taxation. Because what's at stake is taxing rights. This is a project that requires political level commitment, and Secretary General Gurria's statement on the release of the work plan calls that out. That there needs to be very high level political commitment from countries, OECD, G20, and really all of the jurisdictions in the inclusive framework, and it also involves really challenging technical issues. The G20, the communique from the G20 finance ministers meeting this weekend endorsed the work plan put out by the OECD, and also made clear the G20 countries' focus on the need for speed with respect to this project by reiterating the 2020 target for full consensus-based solutions that reflect the agreement on the new rules. So the OECD project is divided into two pillars, and there is some interaction between the two pillars. Pillar one is about developing new set of rules for profit allocation and new nexus rules, And those rules are really the two core building blocks of the international tax framework. So it's going to really fundamental issues by changing, and the aim of the clear aim as reflected in the work plan of these revisions to the existing profit allocation and nexus rules is to get to a result where additional taxing rights are allocated to the market jurisdiction than would have been allocated under the traditional approach. And so by definition, the project will end up with departures from the underlying arm's length principle that has been the central point of existing transfer pricing around the world. In allocating more taxing rights to the market jurisdiction, the OECD project also seeks to ensure that that country can exercise those taxing rights by moving away from the traditional permanent establishment concept that requires that a company have some physical presence in a country, and moving to some kind of virtual PE or deemed permanent establishment, so that the country that where the profit has been allocated gets the associated ability to tax that profit. There are significant technical issues to be addressed as you think about about changing this fundamental architecture. The OECD project is looking at 3 alternative approaches for changes in the rules, and all of them would involve significant technical issues. The first proposal is the one that Freddy briefly described, that has been developed by the UK government, and I think there's significant interest from some other European governments as well, that is focused on user participation. So in some ways it's the narrowest of the 3 approaches in that it focuses on value created by having an active and engaged user base. So it is a very much a digital or social media concept. The other 2 approaches would go well beyond the digital business models or digital activity, and would extend to all cross-border activity. The marketing intangibles proposal has been developed by U.S. Treasury and is being advocated by U.S. Treasury, and it would extend both to digital activity and to any other form of cross-border activity where there's a distributor in a country. And so it is a broader approach that would take the same concept of providing more taxing rights to the market jurisdiction, just based on the serving of that market, whether it's through a user base in a digital context or more generally a customer base. And the third proposal was developed by some of the developing countries, and would adopt a formulary apportionment approach. Part of the work plan is to narrow down those 3 proposals, and I think they're looking to see there are very common elements across those proposals, and so can they be combined into a single approach, and so that's part of the ongoing work. The work requires measurement of global profits. Then rules for determining how those profits should be divided across all of the activity of a global business. So how much of the profits relate to the activity, the market activity, if you're looking to provide taxing rights to the market jurisdiction, and then allocation across what might be multiple market jurisdiction. There are also complex issues that Daniel noted, when you've got cyclical businesses with losses in some years and profits in other years. How will all of that be done? There is a lot of technical work to be done. Most of the participants in the project advocate that ultimately there'll need to be some kind of formulaic approach that will be used for providing this additional taxing rights to the market jurisdiction, because it's something that needs to provide certainty to businesses. It needs to be simple for countries to administer, and they're very aware of the fact that that this is a discussion happening involving 129 jurisdictions with different levels of tax capacity. Pillar 2 is the second part of this project, and it is about addressing the potential opportunities for profit shifting to no or low tax jurisdictions by imposing a set of minimum tax rules. The connection to digital here is the suggestion that digital business models may provide more opportunity for that profit shifting, but there clearly is an acknowledgement with respect to this pillar as well that any rules here would apply would not be specific to digital businesses and would apply across the board. The work plan that was put out at the end of May makes clear that this aspect of the work really is about tax competition, and the view of some of the participants in the project that all business income should be subject to a minimum level of tax in some country. That's a fundamental departure from earlier work of the OECD, and a significant change in the global framework. And there are here too, in addition to political level issues, there are lots of complex technical issues. Where is it that the minimum tax is to be imposed? They're envisioning two sets of interlocking rules. One set of rules that would say that if a parent company has a subsidiary or a branch in a country that imposes no or low tax, it imposes tax below the agreed minimum level, that parent company country has a right to tax that income. The difference between the rate, the actual rate, and the rate, the agreed minimum tax rate. And then a second set of rules that would say that when a deductible payment is made from a country to a business in another country that taxes it at below the minimum level of tax, the country has the right to deny the deduction or to otherwise deny treaty benefits. Those rules would need to be coordinated, so one of them take priority over the other. That there'll need to be a lot of discussion about how to resolve that, because that gives taxing rights to different countries, and issues of determination of what the minimum tax rate is, the measurement of the tax base in order to determine the effective tax rate for income. To compare it to the minimum tax rate raises all sorts of complicated technical issues. So significant work to be done here. And again, as we said, it's being done with a very ambitious timeline. So the work plan indicates the intention of the OECD and the broader inclusive framework to reach agreement on an outline of the architecture for these new rules by January of 2020, so sort of high-level concepts, and then to continue the detailed work to flesh out the technical aspects of the rules over the rest of 2020, with an objective of having a full consensus-based agreement on new rules by the end of 2020. And I guess the last thing I would note here is that's a very different procedural outcome than the OECD's work on the BEPS project, in that what is required here to make this system work and to achieve the objective of avoiding double taxation is that countries all agree on the same specific set of rules, and make a commitment to implement those rules in their systems. Also at stake here is a commitment to eliminate any unilateral measures that may have been put in place in the interim, and there likely will be significant new information reporting requirements to bring into the system the information that would be required, the data that would be required to apply these rules, and also an important aspect of this will be new and improved dispute resolution mechanisms, in particular multilateral dispute resolution mechanisms, because in many cases there may be more than two countries that are involved in one of these reallocations. So a really significant project that is aimed at reaching a global coordinated set of rules that would replace what the unilateral activity on digital services taxes, but they would have implications well beyond the specific targets of those digital service taxes.
Thank you, Barbara. I'll give each of the panelists a quick opportunity to comment on anything I or the other panelists said. Anybody want to?
I'll piggyback off of what Barbara was saying there at the end. So the options in Pillar 1 and Pillar 2 both raise a lot of questions. In fact, the work program probably created more questions than it resolved. But of course, it's this opportunity to work towards a solution. And a lot of those questions are connected to the technical ability to administer these things by multiple countries without creating double taxation, and what information countries would need to be able to implement these things, what the economic effects of these different proposals would be. If you're raising effective tax rates on businesses, where does investment go? Is this just an extension of countries' controlled foreign corporation rules, which we already know has an effect on location of intangible and financial profits and also real investments? Then that extension would also have similar effects. So there's a lot of open questions, both on the technical side and on the real economic effects side. And similar with digital taxes, it's not really clear in these different contexts where the ultimate tax incidence would lie. There would likely be some passing through to users and advertisers and businesses that sell on marketplaces, but it's not clear to what extent that would be. So a lot of interesting proposals for paying attention to the economic effects in addition to the technical aspects.
At this time, if anybody in the audience has a question, go ahead. If you could say who you are and where you're from.
Thank you. Steve Dell, Company NetChoice. Joe, thank you for the paper and putting the panel together. And my question is for Freddy. The 25 million pound threshold. I really want to understand this a little bit better. Members of NetChoice are folks like Facebook, Google, and Twitter. And they earn ad revenue, delivering ads based on targeted characteristics. So would the 25 million pounds be spending on ads from English advertisers, or is it the ad revenue attributable to English eyes?
So I'm slightly hesitant to get into the technical details, but I think it's more the latter. It's the revenue attributable to the interaction with UK.
Meaning English eyes that saw the ads. So a group of advertisers, many in the UK and other European countries and US, would spend money on Facebook to do ads, targeting them to individuals, perhaps geographic or perhaps demographic. At the end of some period of time, Facebook would have to figure out what portion of that ad revenue was attributable to English eyeballs. This is administratively trivial in your mind?
Oh, I don't think it's trivial.
Oh, okay.
The process has been, as I
Right.
described, the government's been working with
Got it.
for a number with the firms over a number of years to design the tax in such a way that it's administrable.
Got it. So it's English eyes. And here's the question. Do you impose similar tax on revenue seen by English eyes if it's in a magazine, newspapers, television, and other media?
Thank you.
Sort of concept behind the DST is that those traditional business models are sort of more easily reflected.
So that's a no, right? So you blatantly discriminate against online ads over
Thank you.
offline.
Next question. How about over here?
Hi, I'm Brett Fortin with Inside U.S. Trade. Just in terms of understanding the some of the European digital services tax issues in comparison with the OECD work, U.S. industry groups and Chairman Grassley have made very clear they think that a lot of the European proposals are discriminatory against U.S. tech firms. Why? What makes them discriminatory? Is it the thresholds, and because most of the tech firms are located, or excuse me, the large tech firms are located in the U.S.? Is that what makes it discriminatory? And how is the OECD options laid out in the May 31st work program? And I believe that was also part of the report issued at this weekend's finance ministers meeting. How does that avoid those issues of discrimination?
So I'll take this, and Barbara, you can fill in, I guess, what I missed. So the discrimination mainly arises from the revenue thresholds. So if you're setting a 750 million euro global threshold before you're bringing a company into scope, then you're automatically saying, okay, certain companies are in and are out. And if you look at the revenues for various firms that might potentially be in scope, most of those firms, or most of the revenues for those firms, are U.S. companies. And for those companies, this would operate very similar to a tariff on their digital tax revenue. And U.S. Trade Representative in their report on trade barriers identified digital services taxes as a potential problem area. Where the OECD's work program differs is that it's the Pillar 1 and Pillar 2 options would apply broadly to more than just digital companies. And though eventually we might see some sort of safe harbor or revenue threshold or something like that, I think at this stage the expectation is this is a rewrite of international tax rules writ large.
I think that's right. The OECD's project is a modification of the framework for international tax in the income tax space, in contrast to the digital services taxes that are not income taxes, and it is a very broad-based project with implications across the board beyond the industry. And new rules that would be implemented through both domestic law and treaty relationships.
The gentleman in the back, maybe, and then you next. Okay. Sorry.
Good morning. So my name's Carl Schonander. I'm with the Software and Information Industry Association, and I'd just like to say that my trade associations, like many other U.S.-based trade associations and others, are very concerned about these digital services taxes. I just say that, I mean, I'm sure everybody's aware that there's a discussion within the U.S. government about a possible trade case. Wherever that leads, certainly in the context of U.S.-EU trade negotiations and U.S.-UK trade negotiations, I think that'll definitely be a factor. So that's my comment. My question is for Barbara. On the OECD work, is that exclusively focused on, I know there's a lot of reform going on, as you explained, but is it exclusively focused on fine-tuning how you define profits and allocating those among countries, not revenues, which is what digital services taxes seek to tax? Thanks.
The OECD project is an income tax-based project, so it changes the allocation, the architecture for international income taxation, and fundamentally would change what are the transfer pricing rules that are used to allocate profits across countries, and at the same time changing the level of connection or the type of connection a business needs to have to a country to be subject to income tax jurisdiction in the country. So the focus is on allocating profits and on the taxation of profits, with the idea that if one country gains additional taxing rights over a greater portion of that, another country will give that up. They're potentially sort of revenues and sales potentially could factor in, for example, in the allocation key for determining once a measure of profit associated with market activity, for determining how you allocate that across markets. Sales could be a factor, but it is a tax on profits.
My name is Ana Fernandez. I'm the financial counselor at the Embassy of Spain, and I have two questions for Barbara. The first one is, what is the level of implication, if any, of the U.S. Congress in the G20 OECD proposals? And the second one is, if any of the new solutions were adopted, how would it affect two tax treaties in U.S.? Should they be renegotiated? Because they are blocked since 10 years ago in the U.S. Senate. And connected with this, how would they affect to U.S. tax law? Because also we have learned from the last tax reform that is really very difficult to change U.S. tax law. Thank you very much.
I think the tax rating committees clearly are watching what's happening in the OECD, just as they're watching the activity with respect to digital services taxes. They hear from constituents. They have a lot of interaction with the Treasury Department, with Secretary Mnuchin, and at the staff level, the Office of Tax Policy and the tax rating committee's staff. They, as I'd indicated, I think the first time I'd seen this happen, or at least the first time in a while, at the request of the chairman of the two tax writing committees, the relevant international tax staffers from the Joint Committee on Taxation staff attended the recent public consultation in the early stages of this OECD project, so that they could come back and report in detail to the tax staffs of the committee, and so then the recent statement made clear they're intending to continue to engage with Treasury and then evaluate the outcomes of the project. In terms of the implications for tax treaties, it ultimately will depend on exactly what rule changes are developed through this process and agreed to through the consensus-based approach, but it seems quite likely that that set of rules would require, in most countries, both domestic law changes and changes in treaty relationships, because a lot of the transfer pricing, as well as the nexus standard, is largely a creature of the bilateral treaty relationship, and so that will require renegotiation of treaties. The OECD has developed a multilateral instrument, which it used for implementing treaty changes for the BEPS project. The U.S. has not been a party to the multilateral instrument. The U.S. Traditionally has kept all of its tax treaty relationships purely bilateral, because of the detailed work needed to coordinate the U.S. system with another country's system, and so I think that the questions that you are raising go to the point that once the consensus agreement is reached in the OECD, there will need to be a period of time for implementation, and some of that could happen through the multilateral instrument, but the kinds of changes that would be required here are quite different than the ones that have been affected through the multilateral instrument. So there may be other countries that prefer to make those changes on a bilateral basis.
Anybody else have a question? Again, go ahead.
I know I'm getting a second bite at the apple, but I couldn't help myself. Sort of a follow-up from Barbara's answer, where she confirmed that the reforms being considered by the international community go to allocating profits between different countries. The digital services taxes are about taxing revenues, however defined. So my question, I guess, for Freddy here is, given that the UK government is committed to the OECD process, given that the OECD process is fundamentally about figuring out how to change tax allocation rights between countries based on profits, a kind of a traditional corporate taxation model, why, for 1, 2, 3 years, what is the reason for, moving towards a revenue-based taxation model for one part of the economy when both the OECD and the IMF have said that it's not useful to ring-fence the digital economy? Thank you.
Yeah, thanks, and it's a fair question. And like I said when I was speaking, the governments recognise the challenges associated with revenue-based taxation. But at the same time, also, as I've sort of touched on briefly, this discussion's been ongoing internationally for a long time, and with very slow progress. And at one stage of conclusion, coming to a conclusion of the discussions with no solid agreement to anything that could be put in place internationally. So I think the government's position was that there comes a time eventually where, and as was signalled in the early consultation documents, where countries may have to move unilaterally, but also being very explicit that there are challenges associated with revenue-based taxation, and the desire still, the sort of number one priority remains to reach agreement at the OECD. And I don't think anyone would accuse the UK of being anything but fully committed to reaching agreement at the OECD and full engagement with that process, but it was moving slowly, and even with sort of more progress and momentum through the start of this year, agreement and implementation remains some way off. So there was just a need to move forward to do something given the scale and the challenges posed to the sort of sustainability and fairness of the tax system.
Sure.
Brett Fortnam again. Just to clarify, I'm trying to kind of match the link here with the OECD work and the digital services tax, and I think this has to go to the point, the difference between the revenue-based and the profit-based work. So, I mean, with the commitments from the UK government and many other European governments, including the Commission, to kind of work with the OECD, why does if the OECD was to come up with a definitive solution on this, where exactly is the overlap if that solution is profit-based while the digital services tax is revenue-based?
So from the UK perspective, and I think it's probably quite widely held view that the preference is definitely for a sort of permanent solution agreed at the OECD, which would be on the basis of income or profit, and the revenue-based taxation through a digital services tax is merely a sort of interim temporary measure until that can be replaced by a permanent solution.
I think it probably is fair to say that the EU proposal for digital services taxes, the two-pronged proposal, was a temporary revenue tax with a longer-term proposal that is being held in abeyance now. But it also focused on a longer-term solution, more like the OECD income-based approach. And I think an important part of the OECD project, when they're looking to reach consensus, will be to seek commitment from countries that have moved forward with digital services taxes to eliminate those taxes as part of the move toward implementation of the income tax. Because otherwise, you'd still retain double taxation. So there's a connection. There's a connection that way.
I'll ask a final question. So I had to read a lot of tax papers to write this report, and it's mind-bogglingly complex. And the impression I get is whatever the OECD does to move to a different system is going to add more complexity. And so are we making a mistake in going that direction, trying to change corporate taxation to move more income toward the destination countries when we really could be encouraging a further movement toward a value-added tax, which gets you the same place. It's basically a revenue tax, or similar to a revenue tax. All the income goes to the destination country, and you don't have to make the corporate laws more complex than they already are.
I think that probably is a question that could generate another conference in the weeks to come. There certainly are a lot of complex issues, and you really can't overstate the complexity of the issues involved in changing the allocation of taxing rights. The OECD and the countries participating in the OECD seem to be well aware of that and committed to make an effort to try to reach rules that are simple and administrable, including ultimately an adoption of a more formulaic approach, because of the importance that the rules provide certainty to businesses and are administrable by countries of all sizes and levels of capacity in their internal revenue services, and I think it will be business community involvement in the OECD project, just as it was important in consultations on digital services taxes around the world, will be really important, I think the ideal outcome, whether it's possible or not, remains to be seen. But the ideal outcome here would be a new set of rules with solid agreement across countries, so that businesses were faced with less controversy than they have today regarding their transfer pricing. But that really would be the nirvana of results of this project, and would be really ambitious to achieve.
Okay, well, with that, we've hit our time limit. If you could join me in thanking the panel, and I want to thank all of you for coming.